Well, hello, everyone. Welcome to the MSA family. We really appreciate the opportunity to update everyone today on the PPP loan program and issues related to uh, the forgiveness applications that folks are contemplating and filling out right now. The audits that will be upcoming for those of you who borrowed over $2 million, and some tax and M&A transaction issues that are also very prevalent today with respect to the PPP loans. We're actually, hopefully, in the home stretch of the PPP now. Program launched in the spring, and that's taken quite a few twists and turns over those 6 months since it's been launched. So kind of a winding road. And our goal today at the beginning is going to be to bring you up to speed as to where we are today. We have a great panel joining me today. I'm going to act as moderator. For those of you who don't know me, and I know most of you, I believe, Marty Borosko from Becker. I'm the practice chair leader there. I have with me Chris Leddy. Chris Leddy is a former general counsel at a staffing firm before he came over to Becker. And then joining us are three partners from Citrin Cooperman. We've got Brian Hoffman, Michael Zaborowitz, and Michael Napolitano. I think will make some special guest appearances from time to time. He kind of drops in out of nowhere with some good bits of advice for everybody. So all four of us, me and the other four panelists, have really spent a good deal of time on the PPP loan program, each kind of focusing in on different areas. So as we go through the webinar, we'll each try and focus in on the areas that we have the most experience. Our intention is probably to spend about 30 to 40 minutes bringing you up to speed on these issues, discussing the important things that you need to know about these issues, and then taking questions. However, if as we're progressing through some of the material, you do have a question, please feel free to type it into the box. Michael Bartels from our office is going to be monitoring the chat program and be funneling questions to us. So if, as we discuss something, a question arises, feel free to raise it then or to save it to the end. So I'd like to jump right in on this. I think that the first place to start, and I'll kick it off, and then BJ, I think I'll throw it over to you, is, something people are overlooking, and that is at times trying to figure out when the heck you should be filing your forgiveness application. A lot of the clients that we've been talking to are giving that careful thought. There's others that, have put the application in and are running to the bank, and I'm trying to reel them in and have a conversation with them to make sure they have the right timing. So I guess the first question is, when you look at it, is it the right time? And I think there's a number of factors to look into. One, there's a lot of uncertainty in what the process is going to look like, how the SBA is going to handle it. You double that uncertainty if you've borrowed over $2 million, because when you file your forgiveness application, you're going to go through the mandatory audit that takes place for anyone who borrowed over $2 million. So in a sense, you've got double the uncertainty in that scenario, and it's still in its infancy. We have a couple clients that have filed applications. We don't have anybody that's been through the forgiveness process yet. I'll ask BJ when I turn this over to him to see if they have a different scenario, and they can tell us about somebody that's been through the process. But we don't really know what the forgiveness process is going to look like, what questions are going to be asked, how much it's going to be scrutinized, how much detail these applications are going to be picked through. Is this going to be a rubber stamp process or a real detailed microscopic review of the applications? Even more so, we don't know much about the audits, at least with the forgiveness application, as Mike and Chris will talk in detail about. We understand what the application looks like. We know what the supporting documentation is supposed to look like. With respect to the audit, we have no guidance out there as to what that's going to look like. And there's really two schools of thought on that. There's one school of thought, and I think we're all going to hope that this is the reality, is that the SBA and the PPP lenders really don't have the resources to do a thorough audit. And that for the most part, the audits will be pretty robotic, pretty superficial, and not much concern for borrowers. So that's one school of thought that a lot of folks out there that have been studying the PPP and talking to people at the SBA and that PPP lenders believe in. But there's another school of thought. There's another school of thought out there that there's been a good deal of controversy over this program. There's been controversy about certain types of borrowers who have taken advantage of the PPP loans. And that because of that, the SBA and the government are going to look to make some examples out of some PPP borrowers. And they're going to look to pick some folks out of the audit process and really look at whether or not they in fact should have received PPP loans. So we really don't have any answer as to what that audit's going to look like. So for that reason, our approach is that you should be cautious about when you file your application. That look, this is a brand new ocean we've discovered. Do you want to be the first person to swim in it? If there's a lot of sharks in the ocean, do you want to wait and let them feed and get full and then jump in? That's probably good advice. There's one other big factor that you got to think about, and that's the tax implications of when you file. And with that, I'd like to throw it over to BJ Hoffman over at Citrin. BJ, maybe you can talk about a little bit of the tax considerations and just follow up on what I've just said.
Yeah, you know, thanks, Marty. In a general sense, our clients are of the same mind. They're coming to the end of the forgiveness period and the measurement period, and everyone's raring to go. Like, what do I do now? How do I get this forgiveness processed? And we are offering similar counsel that you are, Marty, which is maybe you don't want to rush in. And for exactly the reasons you just mentioned and outlined, the uncertainty. But beyond that general uncertainty as to what an audit process might look like, there's this large unknown that nobody is talking about, or almost nobody's talking about, the income tax aspect of this. There is, as it stands right now, a real tax time bomb waiting to blow up in people's hands. And I don't think many people are recognizing that. So backing up for a second, just by way of background, the CARES Act, when it passed, the PPP program was brought into play, Congress specifically said, to the extent that there is forgiveness of these loans, debt forgiveness, that will not constitute taxable income. And that's great. And it's unlike most other tax laws, which say if you are given money in the form of a loan and for whatever reason you don't have to repay that loan, typically that is cancellation of indebtedness income. It's taxable income. Congress said not here, not with the PPP. When this is forgiven, it is not taxable income. Great, right? Sounds fantastic. Well, here's the problem. The IRS, on the other hand, said, okay, we can't go against Congress and we can't make this taxable income, but we really don't, the IRS, we really don't agree with this windfall that in effect has been dropped into companies' bank accounts. In particular, the staffing industry has made out fairly well from the PPP program. The IRS says, all right, we can't treat this as taxable income, this forgiveness, but what we can do is we can deny you the tax deduction for the expenses that you used your PPP funds for. So all those payroll expenses that the PPP funds were used for that are typically tax deductible business payroll expenses, the IRS as of right now has said those expenses are not tax deductible, which is a backdoor way of making this whole forgiveness taxable income. Not many people are thinking about that. Now, that position that the IRS has set forth has really annoyed some people in Congress on both parties. So for once, I know it's shocking, but there's actually a bipartisan movement afoot within Congress to push back. And Congress says, no, we meant this to be non-taxable and truly not taxable. And the IRS, you're wrong, and we don't want you effectively taxing this forgiveness, and we're not happy with this. The problem is, as we know, nothing's getting done in Washington. Nothing will get done in Washington until who knows how far after the election. But it is worth it to know that there is bipartisan support for addressing this issue. Whether ultimately there's some result that's positive for taxpayers, don't know yet. So here's where that leaves us. Right now, what that means is as it stands, when there is tax forgiveness granted officially to you, you have a taxable event. And to the extent that you are trying to cram that forgiveness in so quickly right now and submitting those applications for forgiveness today, hoping that as soon as possible you can get that letter from the SBA saying, okay, you're free and clear, well, that may very well trigger a taxable event in calendar 2020 if you rush it. Most taxpayers follow typical tax planning advice, which is try to defer your tax burden as far out as possible, which may be another reason to sort of sit on this forgiveness application for a few months and have the actual forgiveness, the legal forgiveness, occur in 2021 when we may have some more clarity. You may be able to treat it as taxable income in 2021 rather than 2020, or at the very least, you'll have the choice, if you know early in 2021 that it is going to be a taxable event. A creative accountant may be able to bring taxable income back into calendar 2020, even at that moment in time, if it behooves you. Now, for some taxpayers, particularly those that are having horrendous tax years in 2020, sometimes you may want to try and accelerate income or the forgiveness taxable income here into 2020 and have it taxed at a lower rate than it would otherwise be taxed in 2021, when presumably many of us and staffing firms will have a better year, higher tax bracket. So I guess the counsel is everyone's got their own unique situation. You need to talk to your tax advisor on this, monitor the ongoing news that's coming out, but generally, if your inclination is to defer tax out as long as possible, don't necessarily be in a rush to submit and secure that forgiveness. So that's where we are, Marty.
PJ, we just had one question. One of the listeners asked if your analysis changes with respect to nonprofits who file a 990. Would the analysis you just gave change with respect to a nonprofit?
Well, the nonprofit organizations typically are not subject to income tax. So that takes that piece out of the equation entirely. And I think that puts you back into, the Marty Borosko camp, like, do you want to jump in and be early and subject yourself to any general scrutiny? So if income tax is not in play for whatever reason, you can disregard what I've said, essentially, or at least talk to your tax advisor. I mean, some nonprofits have unrelated business income tax obligations, but in large part, it won't be a taxable event. So,
thanks, PJ. So there's a lot to consider with respect to the timing of your application. Additional considerations, and I'll talk about a little bit of this later, is whether or not you're anticipating going through a transaction. If you're thinking of exiting the business or going through a recapitalization event, you have to think about the timing of your forgiveness application as well, and we'll talk about that a little bit at the end. Let's move now to the actual application and the application process. And Chris, why don't I start with you? I know you've been side by side with a number of our industry clients, helping them get through the application process. Maybe you can talk a little bit about the application itself, and in that, maybe just focus in on what you think are some of the key areas in the applications, and maybe some mistakes that staffing firms might be making in the actual filling out of the application, if there's any you've been seeing.
Okay. Yeah, Marty, thank you. So the application itself really is broken into two parts. You're going to have the application and the certification. The application consists of calculation form and Schedule A and Schedule A worksheet. All three of those together is going to be what you submit to get your forgiveness amount. The other piece is the certification form. Like the loan application itself, where you made certifications, the SBA is again requiring certain certifications to be made. There you're gonna certify that the requested forgiveness was used for eligible purposes, that at least 60% went towards payroll, and that the compensation for owners did not exceed the applicable caps. You're also going to verify that the information, costs, and documents submitted are all true, and that if you knowingly submit false information or use funds for unauthorized purposes, that there are criminal and civil penalties, including imprisonment and fines up to $1 million that you could be subject to. You're also allowing the lenders to share your information with the SBA and recognizing that the SBA may request additional documentation. And finally, you're certifying that if you do elect the FTE Safe Harbor 1, which we'll get to in a few minutes, that you're certifying that you are unable to operate at the same level of activity between February 15th, 2020 and the end of your cover period as you were before February 15th, 2020 due to governmental agency COVID restrictions or guidance. There's also, I'm sorry, with regard to this safe harbor, you're really going to have to look at your financials, job orders, placements, and see if the restrictions or guidance affected them. For instance, most likely most industries affected are going to be the hospitality, airlines, and cruise industries because they've just been decimated. Additionally, if you do meet certain requirements, you can submit under the easy application. For those 3 requirements, it's either or. If you are self-employed and you did not have any employees at the time of the application, you did not submit any employee salaries for your loan application, then you can use the easy application, which is much simpler than the full-blown application. The second reason could be that there was no reduction of more than 25% of any annual salary or hourly wages during the cover period or alternative cover period compared to January 1st through March 31st. And there were no reductions in the number of employees or the average paid hours of employees between January 1st and the end of the cover period. And then finally, the third exception or third reason you can use the easy application is the same 25% threshold, and that you are unable to achieve the same level of business activity pre-February 15, 2020. And then for the 3508, which is the full-blown application itself, at a very high level, it's broken down into 3 steps. The steps are going to be complete the Schedule A worksheet first. There you're going to look at payroll costs. Keep in mind what the caps are for each employee. Keep in mind what the caps are for each owner. With regard to owner compensation, there are nuances there for the type of entity that you do own. For example, contributions for health insurance are not eligible for additional forgiveness for S corporations who are employees with at least a 2% stake in the business because those contributions are already included in the cash compensation. You're also going to determine your FTE value for each employee with that worksheet. However, with regard to this, and Mike's going to speak to it a little bit more, a lot of questions have come up whether the paid leave is included to determine payroll costs and FTE values. And the answer is yes, it is included. FTE values are based on the average number of hours paid, not worked, but paid. Thus, leave should be included except for FFCRA leave, which is an exception to that. Then finally, with the worksheet, you're going to look at the 25% reduction for hourly wages or salary. If there is a 25% reduction, you're going to have to work through that worksheet on the instructions. Next, you're going to complete Schedule A. That'll bring you all your worksheet information will flow into that. You'll then need also to gather your health insurance contributions, your retirement plan contributions, and state and local taxes on employee contributions. Then we're going to get into the safe harbors. You're going to have to determine whether safe harbors apply. Mike and I will talk about that in a few minutes. And then finally, you're going to use all that information to calculate your loan forgiveness on the calculation form. And you're going to include your non-payroll costs, such as your rent, utilities, or mortgage interest, which was paid or incurred during the cover period. Marty, you're on mute.
Yes, I didn't realize. Mike, I realize you kind of are in the same position for Citrin. You've been really walking your clients through the application process. Maybe just real quickly, because Chris gave such a thorough overview of the application, is there any place that you're seeing clients make mistakes, or maybe that they're not quite understanding correctly in terms of the application?
Yeah, so just a high level, and good afternoon, everybody. You know, high level when you look at staffing companies, and it's not really mistakes, but you know, just over broad strategies on how to approach the, you know, the application. And so wanted to highlight a couple things. First, staffing is somewhat unique in the sense that such a large portion comes from payroll expenses, right? So, you know, for many of you, you're going to get to your total eligible loan amount with just payroll. And so, you know, we've been seeing people try to jump through hoops to include non-payroll expenses as well. But all, again, it comes down to sometimes simplicity. If you're going to be able to get there with just payroll expenses, that's that much less documentation that you're going to have to provide to the lender and answer questions to. So again, staffing company is somewhat unique in the sense that you might get there 100% with just payroll. Don't even bother with the rest of the stuff if you get there. You know, in that same kind of vein, you talk about companies that might be able to spend, if you do go beyond the 8-week period, if you're in a 24-week period, you know, you're in a 24-week period, but you can actually submit before the end of 24 weeks, right? So you can submit after 12 weeks, 16 weeks, and there's specific guidance for that. Just be cognizant that those limits, you know, if you're saying, well, okay, during a 24-week period, the cap on an employee is 46,000. Yeah, that's if you go 24 weeks. If you're going 16 weeks, it'll be around 30,000. So just be cognizant. Sometimes we're seeing that. And again, some of the information that comes in, especially on the payroll side, and we'll touch on that next, comes from payroll providers, and they provide supporting reports. And what we've been finding is that they're riddled with errors. And so we're going to highlight some examples of how these reports are wrong and how you're going to need to dive into it. But again, to take this a little bit further, you know, portals are opening up, bank portals are opening up for these loans. And I think that, you know, people are saying, well, listen, once the bank portal opens, I'll input my information and, you know, we'll see the, you know, the way the calculation, you know, works out. I think it's important that you on the side do your own application. You know, and don't rely on the bank. Understand what the rules are, because there are certain banks, for example, Bank of America right now is not accepting any applications before the end of 24 weeks. Now, and I'm not even sure if they're not accepting it because they just want to extend the period of time when they can start to review it. Banks are anxious that there isn't further guidance out there. But if they're going to say that you cannot apply before the end of 24 weeks, that goes against specific regulations. So, no, you know, filling out your application, knowing where you stand, and then having support for it before you go into you know, submit with the bank, I think is key, so that you kind of have a baseline and understanding of where you are and an argument for the support. You know, people rely on the banks. Banks are in no different situation than everybody else. They don't have all the answers. And they certainly, you know, we've been in situations where we've had to provide guidance to the banks to kind of show them where they're missing the, you know, missing the point.
Mike Napolitano, I want to call you in here for a second. I know that you've been really following the scams that have been coming out, you know, like with any type of program. Sure enough, there's folks that are trying to take advantage of people who are maybe misinformed. Mike, maybe you can talk about some of those scams that you've been following and helping clients navigate to avoid.
Yeah, so like any program, especially government program, there are always criminals who try to capitalize on the PPP fund. So what you need to be aware of, I've had a number of clients who would be contacted via email, and the email would look official like most email scams. It would actually be from the SBA-attorney. And what the email does is it basically is preying on fear. And the email will basically say a list has been, there's a list of companies that had access to the private equity markets, and you were on that list, and therefore you need to contact us immediately regarding your PPP loan. You could be in violation. So what's amazing is when it hits. So I received an email, and within 24 hours, 2 more clients received the same email. So some things to be aware of is the IRS is not going to contact you via email. So if you do get any phone calls, if you do get any emails, any correspondences, make sure you're reviewing it with your professional, because as this program continues, the thinking is there'll be even more scams. So just keep in mind, SBA does not email you. So be on the lookout. I'm sure there'll be more coming. And again, keep your professionals informed, and just do not reply. Sometimes just replying can get you caught up in the scams. So that's it on the scam side, but more to come.
Thanks, Michael. Mike, I want to throw it back to you on the kind of the supporting records and the information that some staffing firm owners who use a third-party payroll processor, the information they get from those folks, and how that information can really be incorrect in terms of the information you should be providing in your application and to support your application.
Yeah, that's absolutely right. And so I know that, staffing companies, especially the larger you get, it might not necessarily be conducive to using traditional, payroll providers, but, the payroll providers in general have been doing a good job providing the information that tied directly into the applications that Chris talked about. And this is, again, with payroll related expenses. We can talk about non-payroll related expenses and issues that we're seeing there. But the problem is that as we go through these programs, again, they're created for scale, right? So ADP has, millions, if not billions of employees or companies that they provide, these reports for. And so, again, it's difficult to create something that catches every situation. And so we wanted to highlight, just some areas where we're seeing mistakes, and I think it's extremely important for you, the business owner, to review and verify the accuracy of these reports, right? So first of all, these reports do not identify business owners. So business owners generally have smaller caps than normal employees. And they also aren't counted as full-time equivalents. So, again, to the extent that you are an owner, you are counted as a full-time equivalent, and your cap is higher than it should be, it needs to be reduced, right? So the next thing is for full-time. There's a report that shows you kind of the full-time equivalency, where you were at look-back periods and where you are at the covered period. And some reports even do the calculation, the ratio calculation for the FTE wage reduction. Again, the issues that we're seeing there are, the categorization between hourly and salaried employees. If you're a salaried full-time employee, it doesn't matter how many hours you work. You're one FTE. Yeah, I mean, because in reality, you can work 50 hours, you can work 30 hours. You're a full-time employee. You should count as one. If you're not categorized as such, you're going to be a fraction, or you might be a fraction. Again, it might be miscalculated. The next thing is that when we look at, we'll have employees whose information is excluded from certain look-back periods for no reason. They weren't terminated. They were hired the entire time. It's just missing. So it's important to kind of to look for it, and that's from that standpoint as well. They provide wage reduction, to ensure that if you reduced your wages greater than 25%, obviously anything greater than 25% is a dollar for dollar reduction of your eligible expenses. Again, those reports have significant errors in them, as we found. If there's an issue between categorizing somebody as full-time or hourly, sometimes you can have a full-time employee that, just reduced their work week. But if they're categorizing correctly, those reports are picking up any reduction in hours worked as a reduction in wage, and you're not going to get penalized for both. It's either one or the other. It's either your reduction in FTE or your reduction in salary over 25%. It's not both. So, that's an issue. They miscategorize. Sometimes they include people whose wages were over $100,000 at any point in time, either look back period or covered period. Again, those people do not belong in that calculation itself. So be on the lookout for that. If you're using a covered period shorter than 24 weeks, again, there's calculations in there that have to be adjusted. So sometimes those reports don't account for shorter periods, so covered periods. So, if you're using 16-week period or 18-week period, you have to make sure that those calculations, that those reductions, that it's not based on a 24-week period. Again, if you're using a 24-week period and the calculation of your covered wage rate is based on a 24-week period, it's going to reduce what the average rate is, and it might result in a calculation that gives you a deduction when essentially that's not true. So no, those issues are related to, that report. We also see, just in general, the payroll reports show you periods that, were paid during the covered or alternative covered period. What they don't account for is if you incurred payroll and then paid it at the next pay period following the covered period. Again, that can be included. So make sure you don't shortchange yourself as far as, what payroll costs you can include there. It's everything that's paid during the covered period and incurred during the covered period and paid directly after the covered period or alternative covered period. So those are probably the biggest issues that we're finding with these report. And again, it's important for you to take a look at it, check it, see if there's anything significantly out of whack. We have discussions with owners saying, listen, I understand this report might be off, but it doesn't really matter. Even if I change it, I'm still going to get to the same point. That's a valid point. That's fine. But you want to make sure that the differences, the changes aren't going to result in something that's going to reduce what your forgiveness is going to be.
Thanks, Mike. Chris, in terms of the supporting documentation, you spoke about the application. Obviously, Mike just spoke about kind of third-party payroll processing information. In terms of the supporting documentation, maybe you can give the audience, 2 or 3 important items to really make sure they're aware of and that they're doing correctly in terms of the supporting documentation.
Yeah, sure, Marty. So there's a category that you have to submit with the application, and there's a category that you have to maintain but doesn't have to be submitted. All the documentation has to be maintained for 6 years after forgiveness is achieved or a forgiveness decision is made. For the documents that have to be submitted, you're going to submit all your payroll information that evidences your right to the forgiveness. So these can be bank account statements, third-party payroll provider reports like Mike just spoke about, or your tax forms such as 941s. For the FTEs, again, you're going to need documentation showing that the average number of FTE employees on payroll per week for the chosen reference period. For the non-payroll, which is the rent, utilities, mortgage interest, if you have lender or account statements, that should be sufficient. Canceled checks, again, will also be sufficient. And like Mike said, those are for either paid or incurred during that covered period. So that's really, in a nutshell, what you need when you're going to apply for forgiveness.
Thanks, Chris. Mike, why don't we talk about the FTE rule? And I know there's been a lot of discussion about it, but it's so critical to getting the right application for forgiveness and the right calculation. Maybe you can talk a little bit about the FTE rule.
Yeah, so if you, and I think most of you are probably familiar with it. I just wanted to kind of give a quick overview about it. When you look at the plan as a whole, what the SBA try to do is they try to get people to, get their employment levels back to pre-pandemic, right? And then the measure of what those levels are full-time equivalents. I think some of you probably have, historically done full-time equivalent calculations for ACA, although this calculation might be, slightly different. So again, FTE, we talk about full-time equivalent. There's 2 methods by which to measure it. There's, anybody 40 hours or more is 1 full-time equivalent. Anybody less than 40 hours is a factor of 40. So 10 hours is 0.25, 20 hours is 0.5. Or you have a simplified method of anybody 40 hours or greater is 1, anybody less than 40 is 0.5. And you can be 39 hours or 1 hour, you're going to be 0.5. And so what's important is, one, that you're consistent in your approach when you look at, how you're calculating both in the look back period, the safe harbor period, which Chris will touch on, or the alternative covered period. And so, the basic calculation itself is you have a numerator and denominator. The denominator is essentially the full-time equivalent, average full-time equivalent during one of the 2 look back periods. There's a third one if you're deemed seasonal. But, again, figuring out what is the lowest number there, and that's going to be your denominator. Your numerator is going to be your average full-time equivalents. during the covered or alternative covered period. If obviously the average is lower during the covered period as it was compared to one of the look back periods, you are going to have a reduction unless, as Chris is going to talk about, you qualify for a safe harbor. The other thing, and we've talked about this before, if you do have a reduction, for simplicity's sake, let's say you had 10 people during your look back period and you had 5 full-time equivalents during the alternative covered period, you had a 50% reduction. If during your covered period you spent $2 million, your loan was $1 million, and during the covered period you spent $2 million on eligible expenses, the way the calculation reads now is that reduction, that 50% reduction, is of that higher level, of that $2 million, which still gets you back to that $1 million to cover your loan. And so one of the considerations, when people say, should I file now? One of the things to look at is, one, did you spend everything, under, the loan? And two, do you have a reduction? And if you don't qualify for safe harbor, do you have enough of expenses spent so that the reduction still gets you back down to at least the loan amount? And again, that's key, and that's the way. It doesn't necessarily make sense that, it wouldn't be capped at the loan amount, but again, right now there's no guidance to do that. And so that's almost like another safe harbor, that's out there. And again, this became prevalent during a 24-week period. During an 8-week period, I think it was difficult unless you're a max loan, a borrower. You didn't really come across this issue until the 24-week period.
Thanks, Mike. That's really important because not many people at all are talking about that kind of additional safe harbor that isn't in the
Right.
code and the regulations, but when you do the math, actually it seems to exist. Chris, why don't we talk about the safe harbors that are actually written into the regulations now and how they work and some of the important aspects of those safe harbors.
Yeah, so you have the exceptions to the FTE rules and you have the safe harbors. The exceptions consist of somebody being fired for cause, voluntarily resigning, voluntarily reducing their hours, or where you offer their job back. As long as everything's in writing and you can show that, it's an exception to the reduction of the FTE count for the employer or their FTE value when you're doing the calculation. For the safe harbors, again, we already discussed the first safe harbor, which is you can't get back to the February 15, 2020 levels because of COVID compliance, whether it be through sanitation, social distancing, or any other safety requirement passed by a governmental agency. The second one is probably or it's going to be more prevalent, is you're exempt from the reduction in the loan forgiveness based on reduction in the FTE employees if you reduced your FTE employee levels in the period beginning February 15th and ending April 26, 2020, and you then restored those FTE levels by not later than December 31st to pre-February 15th levels. So like I said, the safe harbor number 2 is more likely, and depending on your circumstances and your forecast, is another reason not to rush into applying for forgiveness, especially if you think you're going to ramp up by the end of the year as the economy hopefully starts to come back more and more. You should start hiring more and more, so it should serve to not permit a reduction in your FTE values.
Thanks, Chris. Thanks. Really appreciate the thorough walkthrough of the issues surrounding the applications and the documentations of forgiveness. I want to shift gears now because at the outset I spoke about how for those borrowers who borrowed over $2 million, the filing of your forgiveness application is likely going to trigger the mandatory audit. So BJ, maybe I'll kick this off again and then you can fill in some gaps. But I've been working a lot with our clients in terms of trying to prepare for this audit. And again, we're preparing for something that we don't really know what it is. So how do you do that? Well, we're really drawing upon the experience that we have in representing clients in other forms of audits, right? There's lots of governmental agencies out there and that do investigations and audits, and there's some key takeaways that we've learned in dealing with those audits. And to me, the first key takeaway is whenever you're faced with an audit situation is you want to control the story, right? You don't want to let the governmental entity control the story. If you let them control the story, you end up going down paths that you would not have gone down if you controlled the story. So right off the bat, you want to prepare, right? You need to be ready for the audit. You need to understand what the SBA or the PPP lending bank might be looking for. And again, when we're talking about the audit, they're really auditing, were you entitled to the loan, right? That's the question that's going to be audited. They're going to look at that certification that you signed that said that there was economic necessity for you to take this loan that was caused by the pandemic, or there was at least a threat of a negative economic impact upon your business at the time you took the loan. And then, as we know, in the FAQs that came down, there was a second test that was imposed on the certification, and that was an access to liquidity, right? Did you have access to liquidity that could have helped you stem the impact of the pandemic upon your business without resorting to taking the PPP loans? So you need to be ready to tell that story, right? You need to be ready to tell the story about the economic impact or the threat that the pandemic had upon your business. And you need to tell the story about what access to liquidity you had or you didn't have. So you want to be ready with that story. And what does that mean? That means you need to have, Chris was talking about documentation that you needed to hold. Well, you need to have this documentation ready. What impact did the pandemic have on your business from an economic point, or what threatened impact did it have? And that could be very bottom line numbers, drops in revenues, drops in profitability. It could also be kind of KPI, right? There could be certain KPI that was trending downward, dropping off a cliff or suffering at the time that this pandemic happened, that gave you great pause as to the potential impact on your business. An example, orders, the number of orders that you were receiving when the pandemic hit and started to really grind most of the country to a halt. Maybe your orders dropped. Maybe the time to fill your orders was delayed, right? You were filling orders very quickly before the pandemic. Now you've got less orders and it's taking longer to fill them. Folks may have canceled orders. You may have another set of issues. You may have had clients who were suffering and offered to change their payment terms to you, or asked for discounts, right? So all of these things have to be put somewhere so that you have access to them, so that you can tell this story in the audit process when you're asked. You also have to then look at your liquidity, right? So understand, did you have cash on hand? How much cash on hand did you have? Did you have any type of access to loans? In the staffing industry, quite often it's an asset-based loan of some type, right? Those asset-based loans have all kinds of covenants in them, right? They also have formulas as to what your borrowing base is, right? So you might have a $5 million borrowing base at its peak, but under the formula, right, which is a percentage of your receivables that are in the formula, usually 90 days, sometimes different. Your actual borrowing base during this period might have been shrinking. So your access to liquidity might have been diminishing. But you want to have that information ready for you. You want to know what the story is. Here's the economic impact that took place. Here's what we were afraid of. Here was our liquidity. It clearly wasn't sufficient. And what was going to happen is we were going to have to let people go. And that's exactly what this program was meant to prevent. So that's the story you want to put together. BJ, obviously I want you to fill in some blanks. One of the things we told our clients to do a lot of was cash flow projections, right? So that they could really, A, run their business, right? But B, be prepared for these audits. So fill in any blanks in what you're telling clients about preparing for these audits, and talk about maybe, you know, cash flow projections and how important they are in this equation.
Yeah, Marty, hey, that's a really good job of giving a great overview of what we're thinking about. I mean, seriously, it's almost like you want to be able to present that, that story that, but for the receipt of these PPP loan funds, you would have let go of internal employees. You know, you would have changed your business. There would have been layoffs. Being able to tell that story is really important. You know, from a 30,000 foot perspective, this notion of going into the unknown of an audit, an SBA audit or a bank audit, should be viewed, as you said, as if you're going into an IRS audit. You want to have your records together. You don't want to be fumphing around and submitting things that are wrong, incorrect. You know, I'm working with a staffing company right now, not on PPP, but an inherited client who has an IRS audit from back in 2018, and they've already delivered a mess to the IRS. You can't be doing that with government representatives. It just creates a morass of questions and skepticism. So you really need to be clean. And I would encourage you to share your documents, or at least have someone, an advisor, take a look at what you're submitting, or contemplate what you're contemplating submitting before you actually submit. I think that that's probably a prudent approach. One question that we are getting in terms of our clients and applying for forgiveness is this notion of, yeah, I'm ready to apply for forgiveness. By the way, you know, we've got a lot of cash in the bank at this point from this PPP, and things are going great, and I want to take a distribution now. You know, I want to get this money out of the company. We're a lawsuit target. It's always good to not have excess funds in the company. Can I go grab that money now? And the answer is, it depends. You know, if you're looking to present a picture to a governing body, a government body that's looking into your forgiveness application, and you clear out the bank account and stick it in your pocket, that may not look good. There may be reasons for that, and it may be justifiable, but that's something to think about before you take that distribution. Similarly, we've had this conversation before, you don't want to be out there buying a boat with PPP funds, right? It just doesn't look good if anyone's poking around. So until you have this forgiveness and you have it in the rearview mirror, I think you want to be careful a little bit with the way you're operating your business, and hopefully you're not operating outside the ordinary course of affairs. And keep that in mind as you look at this forgiveness process. Mike, if you want to add anything, have at it.
Yeah, I think we said this before. There's no more boats left; they're all bought up. But no, I think Marty, did a great job summarizing it. You know, we spoke to our clients. Marty and I, we've worked on similar clients together because you know the picture, the where you are today is probably much different than you were in March and April. And so, you know, when you talk about mindset, it's difficult to kind of capture at this point, but, you know, if you haven't already done so, you know, try to, you know, provide a narrative that outlines what Marty talked about, so that, you know, if somebody questions you, again, it's difficult to kind of say, no, you didn't have uncertainty. I mean, how do you get in somebody's head? However, I think that, you know, to an extent, it needs to be supported by some facts on the ground of where you are at that given point in time. And I agree, from what I saw, the biggest uncertainty came from a shrinking borrowing base because your receivables were growing older, your servicing industries of people that weren't going to pay you. And that uncertainty in itself, whether it came to fruition or not, I think was a significant, you know, a factor to justify, you know, people needing these loans.
Thanks, Mike. One last subject that we'll touch upon real quickly, and then we'll open up the webinar for questions, and that's transactions and how PPP loans are impacting transactions. I know I've spoken to a number of people at MSA about staffing industry M&A, since that's where I spend a majority of my time, and PPP loans and the existence of them is really having an impact on transactions, because under the regs, within the first 12 months of obtaining a PPP loan, a PPP lender cannot consent to a change of control without first getting what they call internal approval from the SBA. So anybody that's involved in an acquisition or considering an acquisition right now needs to know that there's a lot of uncertainty in how you go about obtaining consent to the transaction. And how it's done really differs depending on the type of transaction and the circumstances that exist. And I'll just run through a couple of the scenarios because obviously this is going to apply to a limited segment of the audience. But if there's a stock transaction, that's being processed a little bit better by the SBA, and that's because in a stock transaction, there's assumption of the liability that existed because you're not really transferring assets in that case. You're really just transferring ownership of the company, and the borrower is still the same borrower, and the borrower is going to continue to be liable for the PPP loan. There is some question as to whether the new owner has to requalify as a PPP borrower, and you can suspect that that is probably going to be the case, that the borrower will have to requalify. What's become a more difficult situation is in asset purchases. In asset purchases, it's very uncertain and cloudy as to whether or not, in fact, you can gain internal SBA consent, although over the last 14 days, the SBA seems to be working through that a little bit better than they had in the past. But why is that? Well, in an asset purchase, right, you're taking all the assets of the PPP borrower and you're taking them out from under that entity and you're putting them in a new entity that is not the PPP borrower and that hasn't signed any promissory note or made any application. And it's not a secured loan, right? So there's no protection for the PPP lender and the SBA bank. So the SBA for a while has just been shutting down consents because it hasn't known how to handle this situation. So in this type of situation where there's an asset purchase, you have to be a little bit more creative. And there seem to be a couple solutions that are out there. One is, even though the intent of an asset purchase is not to bring over the liabilities of the seller, right? The whole point of an asset purchase is you're going to bring over the assets and you're going to leave the liabilities there. And it's a risk mitigation factor for a buyer in a transaction. Well, if you assume the PPP loan liability, you don't assume the other obligations, but you assume the PPP loan obligation, that could be one potential way to get SBA consent. The best way that we've seen out there is creating an escrow and depositing the PPP loan principal amount in the escrow pending a forgiveness application. And then obviously if there's full forgiveness, the money goes to the seller. If there's not, then the deficit on the forgiveness goes to the PPP lender and the remaining money goes to the seller. So in that circumstance, that's the best way to get to consent because that gives the banks and the SBA full security that they're going to get paid if there isn't forgiveness. What becomes complicated, and then I won't dive into the weeds anymore on this, and anybody who's in the middle of a transaction or contemplating a transaction, kind of a friend of the MSA, I'm happy to jump on a phone call with you for a few minutes without the stopwatch or anything on and give you some more help. But what's really confusing is if, a lot of people have been fortunate, right? They've been able to borrow the money and the business has rebounded, right? So they have, they've been able to build cash during this period and they've been able to save jobs and really be in decent shape. But if you don't have to build up that much cash, right? Well, what do? You had a $2 million PPP loan, but you've only got $1.2 million in cash. How are you posting that escrow, right? So that's where it gets very complicated in figuring out a solution to that. and obtaining the consent can be done, but very difficult. I guess the biggest thing I would say is if you're contemplating a transaction right now, understand that working your way through this PPP loan consent process is going to add time to the transaction timetable. And it's probably going to add some cost because your professionals on both sides are really going to need to figure out what the best package is to present to the SBA to get approval. So I think those are the hot issues that we're seeing. I'm happy to answer any questions for the last 5 or 10 minutes that we have here. If anyone in the audience has any questions. I've seen one question that we haven't gotten yet, but I'll throw this out to Mike and BJ. And that is, when you look at liquidity, I always get clients that came to me and you look at their financials and they have a lot of retained earnings that they're holding on their financials. And we've gotten into a debate as to whether that was liquidity that they had available to them and should have been considered liquidity instead of a PPP loan amount. What have you been telling clients about retained earnings and whether that was in fact liquidity that they had access to or should be put into the equation in looking at whether or not they should have taken a loan?
You want to take that?
Yeah, I mean, so again, when we talk about, a lot of times, we'll talk about, taking money out of the company and how you're going to take money out. And it could be based on an accumulation of funds over the years. But take a look at what you're exactly spending for, right? So for instance, if you're taking a distribution to pay off taxes, I don't think anybody's going to fault you for it. And again, if you're taking distributions that are in line with prior years, I don't think anybody's going to fault you for that. If you're taking significantly higher distributions from previously earned income, during the period, that, then kind of brings in the question of whether you are actually profiting off a windfall, which again, as Marty said, this can be a windfall for certain companies. It's just from an appearance standpoint, how does it look?
Hey, Marty, if you were sitting with a boatload of cash when you made the application and a boatload of cash equivalent to retained earnings, which you call retained earnings, is it disqualifying? Or really, it's not a fact that's helpful, I would think, in the event there's scrutiny.
Yeah.
Go ahead, Mike.
Marty, one last thing, and I just, before we run out, I wanted to kind of we talked about the effects of, the tax effects of it. When you look at your books, some of you might have lending agreements and have to meet certain ratios, and some of them might have workers' comp ratios that prevent you from, adding additional funds in escrow. Keep those in mind. Look at your balance sheet, how it looks now. If you have current ratios on there, calculated as if, the PPP loan was current debt, because it's likely going to be treated that way. And you should have more than enough cash in AR to offset it. But again, during the planning of the fourth quarter, just understand it. And from a GAAP perspective, you can take two routes essentially to relieve the liability. Once, the safer, once I get a letter of forgiveness, I can take that into as forgiveness of debt, other income. The other one is kind of comes from international standards, since GAAP doesn't necessarily have something in place to deal with this specific situation, that you could take it into income as you spend the expenses. And if for some other reason you weren't forgiven, you would flip it back up to a liability. But again, from planning purposes, try to figure out whether you're meeting your metrics. It's a strange year, but lenders and insurance companies are going to kind of hold you to what your numbers look like at year end oftentimes. So look at that and make the necessary steps before year end.
I just got a really good question in. What's the best way, is the question asked, to account for any reduction in pay issues? And we know there's many staffing firms like that. When you're a high turnover staffing firm and your current workers are new, right? Because you're a high turnover staffing firm and they didn't work during the measurement period.
Yeah, so they wouldn't count for the calculation. So essentially, you look at it like who was in place, in the first quarter, That's your starting point, and you compare the wages for those people that worked in the first quarter to the wages that are calculated during the covered period. So again, you can make the argument in a traditional company and you replace them with somebody of an equal level. But again, in temporary staffing, it's so difficult to match it up because the people are basically, it depends on what the jobs are. So, you know, in those instances, in that example, I don't think, you know, those people would not be included in that calculation because it's not a one-for-one trade-off. The other question that comes up in staffing is that, well, I have salespeople and their commissions were much higher in the first quarter, and you know they're not selling as much during the covered period. SBA kind of came out, or Treasury came out with a FAQ that essentially says this calculation is limited to wages. And if you look at the definition, commission is different than wages. So it's really the wage rate that you're looking at here. And the commissions are on top of that, would not be factored into, it's not necessarily a gross, you know, calculation versus just a rate calculation.
Thank you, Mike. And I guess I want to just follow up and then we can end it there on really advising everyone on this to adhere to something that Mike just said at the end. A lot of people overlooking the impact that this drastic change in their business might have on their asset-based lending covenants. And it's really important because I've seen a real trend in ABL loans being reduced by banks, right? Because they're nervous. There's been an impact on this industry in some sectors in particular. Banks tend to get very nervous, right? At the outset, after a recession, banks get very nervous and very tight. We've had a number of clients who've had their borrowing base not just reduced by the formula, but the total amount that they can borrow reduced, right? So really critical in this year in particular to get out in front of these issues, to know if you're outside of any covenants, to know and tell a good story to your bank about your business if in fact you were impacted by the pandemic. Be proactive is always my advice with banks. Be proactive in telling them that you might be outside of covenants. Be proactive in telling them what your plan is, where you are, and how you're going to recover, because there's going to be a number of folks. We've already had, I think, 7 clients who've had their ABL line of credit reduced in the last 2 or 3 months. Well, everyone, I hope you found this informative. Always a pleasure to work with the folks from Citrin. I'm sure we'll be talking PPP on many occasions with the clients that we share. And it's always nice to have the opportunity to speak in front of the MSA family. Thanks, everyone, for attending, and we'll talk to you soon.
Thank you.